U.S. stocks sinking this morning as President Trump threatens 50% tariffs on the European Union, jolting stocks in what was shaping up to be a quiet trading day. The president also threatening Apple with tariffs, reigniting investor fears over the trade war, which last month sent stocks into a bear market. Joining us now, Joe Hegener, Asterozoa Capital CIO. Joe, thank you so much for being here with us this morning. Is this a reality check for a market that had somewhat forgotten the fact that we had not had any trade negotiations or deals yet with any of these countries?
I think that's absolutely right. Yeah, thanks for having me. Especially in the last few weeks, just given all of the crazy headlines that have come out and moved the market in such dramatic ways, up, down, left, right. I feel like there's been a lot of short-termism kind of embedded within market volatility. The only thing we really got, as a relief to, that April 2nd independent tariff implementation was a 90-day pause. And even then we knew that the best case scenario was a flat 10% tariff rate across all of the nations. And that was the best case scenario, assuming that every single country comes to the table and negotiates in good faith, which we're somewhat skeptical that actually takes place, given this administration is fairly aggressive in their posturing.
Joe, with all that in mind, is President Trump still seen by the business community as a pro-business president?
Oof. On the one hand, he's very pro-business in the sense that he wants lots of deregulation. He wants tax reform and tax cuts. He wants to cut all the red tape for the banking sector, and all of that is incredibly positive. But I think something that a lot of the Trump supporters from the business community didn't fully appreciate going into this administration was just the level of uncertainty we would get from a policy standpoint as it relates to tariffs and lots of other headlines. It's very, very difficult. If I'm the CFO of a business, I have no idea what the world's going to look like. I don't know what my input costs are going to be in 6 months from now. It's going to be incredibly difficult for that CFO to sign off on CapEx spend and R&D and research when we just don't know what the revenue profile, the expense profile of the business might look like. And that pullback from the uncertainty alone could create earnings recession.
So if CFOs and the C-suite of these companies don't know how to best forecast amid strategic chaos, as the White House and some of the cabinet members have talked about it, what are investors supposed to do?
Investors, in my opinion, are supposed to batten down the hatches. In terms of the normal distribution of potential outcomes, the left tail and the right tail. We kind of believe that the tails right now are incredibly fat or wide, meaning that it's very likely, with the historical lens or probabilistic lens, that we get a serious scream upwards in markets, but it's also very, very likely that we get a serious pullback, right? The days of kind of low and slow and the S&P 500 steadily going up by 25 basis points a day on average, we had about a 10-year period where that was the case. And, currently, the sheer volume of volatility or the amount of volatility embedded within markets, I think investors should embrace fixed income. A 4% risk-free yield is nothing to scoff at in this environment. And, if you're willing to move up the stack a little or down the stack a little bit, you can lock in high single-digit returns, which are equity-like returns, and you're not taking the massive amounts of risk embedded within equity markets right now.
Yeah, and I wonder how much more risk premium needs to be baked into equities to be worth that risk in this environment. But having said that, we also have sources telling us that there's risks within the bond market. Obviously, Michael Hartnett this morning was saying to go longer in the yield curve here. But to what extent do you think investors are maybe worried about things like that 20-year auction and demand issues if they do go in on bonds?
That's a great point. It's somewhat nuanced within fixed income, right? Because there is definitely a risk where if this tax bill actually passes and we're adding $4 trillion to the deficit, if we get more deregulation, if Trump installs somebody who we know is going to cut rates next year, there's a serious chance that the long end of the yield curve goes substantially higher from here. And that's one of the reasons why at our firm, we actually have what's called a yield curve steepener on, where we're effectively betting on the front end of the curve to come down, but we're actually short the long bond to try to offset against that risk of yields going dramatically higher from here, and actually provides a nice hedge to the rest of our bond portfolio. But that's definitely a material risk, right? That long end of the curve, there's a tremendous amount of uncertainty, and we're starting to see investors get a little spooked, and what's going on in Japan and abroad is only exacerbating that risk.
And so as you're thinking about, for all of the kind of market sentiment that had really been looking at just anything positive to come, especially after the early onset of April's Liberation Day announcements and then the rebound thereafter, that was really just, okay, we're going to pause things. And as Maddie had pointed out when we were in the newsroom earlier today, we're halfway through that pause. So what are investors who are looking for the next major positive catalysts, or just hanging their hat on anything that seems favorable to come out, what are they going to look to next that seems like the next big driver here?
Oh boy. Personally, I'm bearish, just in all honesty. But I think if you're a bullish investor, I think what you're looking for are developments, positive progress in tariff negotiations. Hopefully this 50% slap on the EU is just a negotiating tactic and it gets resolved. You see tariff progress, and then you see the passage of a massive fiscal stimulus bill. Right, that's an enormous amount of stimulus that's going to be injected in the economy if that passes and gets through. Not to mention the other leg of the stool, deregulation. Just purely deregulation from a banking standpoint. If they adjust kind of the capital requirements for the banking system, that actually allows all the major banks to be net much larger buyers of U.S. Treasuries, which could also help pull yields down, which would be supportive of the economy.
Joe, thanks for taking the time this morning.
Thank you.